Yeah, hi there. Well, we put another quarter to rest here. So the first half of the year ended on a high note. We obviously got some more positive news out of the weekend. The G20 meeting, which was well anticipated, ended at least with a truce on the tariff side. So that is obviously good news in terms of the escalation of the tariff war. The only really concrete news that we got out of the discussions with the Chinese was really more centered on the obviously the ban on chips and so forth that were to be sold by U.S. companies to Huawei. So that's really the only concrete thing that has come out of this, because obviously the supply chain, the technology supply chain, could be very much disrupted if we're basically dividing the dividing the world between a Huawei network on the one side and a Western network on the other. If that means chips and software cannot be sold by U.S. companies into that Asian network, if we want to call it that, that obviously would be very disruptive to many of the suppliers in the supply chain. So what you're seeing today is a bounce, a pretty strong bounce in the semiconductor side, looking even stocks like Qualcomm and so forth that are operating in this space are beneficiaries today. That said, I mean, the market is up 18.5% year to date. That's a lot. If you were more skewed to growth, which is sort of more our bias, you're actually up over 20%. Balanced accounts are between 14 and 18% roughly, depending on your asset allocation. What was nice to see in this quarter, if you look at the top performers in this last quarter, so there was a nice mix of stocks. I mean, it wasn't that one sector like tech or something dominated the performance. So if I look at our top 5 performers for the quarter, Disney, Broadridge, Illumina, Facebook, Starbucks. I mean, these are 5 very, very different companies. I mean, Disney obviously is going through this digital transformation. Disney is a stock we started buying a couple months ago, and that was based on its rollout of its streaming business, the Disney Plus business, and the now wholly owned Hulu business. That's kind of really being reconfigured, and the Disney Plus business is being launched in November. So there's a lot of anticipation here on that service. And if you think about it, this is recurring revenue. So what we've been emphasizing in this more difficult macro environment, where we're kind of at the end of the typical business cycle and probably rolling over here, we want to emphasize companies that are a little bit less cyclical and more on recurring revenue, on the recurring revenue side. So Broadridge was our second best performer in the portfolio this quarter. That's one of these. I mean, in a simplistic way, they do proxy voting. So if you work in our kind of jobs in Wall Street, you're a fund manager, pretty much everybody uses Broadridge for proxy voting. Broadridge has branched out into all sorts of services for fund managers and asset managers. So, but the key is it's a recurring kind of business. So the third best stock was Illumina. That's obviously that's a healthcare stock, and Illumina does all the it makes the machines for genomic sequencing or DNA testing. That is obviously seen an explosion of growth as their technology. Illumina has basically invented a machine over the last 5 years that's brought genomics testing cost down to less than $1,000 per genome, which is extraordinary if you think about just 5 to 10 years ago, you spent millions of dollars just to sequence or one human genome. So that's a stock we continue to like. That's had a nice move here. Facebook is number 4, the 4th best stock. That's the only stock that overlaps with our top year-to-date performers. Facebook obviously didn't have a great year last year, and that was really because of its business model. being questioned, and with all the regulation issues that are facing really all the social media companies. But it's interesting. I mean, the Facebook has clearly taken this head on, and they've already moved one step further from the regulator that's on their after them, by basically shifting its focus to payment systems. So they made this announcement or about their cryptocurrency. I mean, this is not really a cryptocurrency, but think of it as an online payment system within their network. So if you're connecting 2 billion people in the world, if you can somehow connect them and monetize and have monetary transactions within that platform, within their WhatsApp platform or Messenger, that is obviously very powerful. So the market has reacted very positively to that, saying, okay, well, the old Facebook model may not be a thing of the past. I mean, if you think of news feeds and things of that may be the thing of the past, but the future for Facebook is really payments and monetizing their network activity that way. Our fifth best stock this quarter was Starbucks. Starbucks is also, if you think about recurring revenues, their payment platform and their online payment platform and their rewards program is really doing very well. They've stabilized their same-store sales base in the U.S. and they're still growing, very well and expanding in China. There were obviously a lot of worries about China, but one of the big growth markets for Starbucks is really China. So those were the 5 best performers for the quarter. It's interesting then, if you look at the 5 best performers year to date, slightly different stocks. The only one that overlaps is Facebook. Then the other ones are companies like MasterCard or Visa. It's amazing. I mean, the credit card has won the payment battle. Clearly, I mean, we're going cashless, and the credit card companies in those platforms have really won that battle. We continue to like those stocks. They're no longer cheap, without a doubt. But in this market, you have to pay a premium for growth. I mean, this is a low growth environment. Companies that have sustainable above average growth are the ones that get premium valuations. Number 3, the third best stock for the year is Ulta Beauty. That's also a stock we own for our growth, more in our growth portfolios. They've done a terrific job. I mean, the beauty space is not an easy space to be operating in. There's a lot of competition, but we're seeing this duopoly really between Ulta Beauty and Sephora that are really becoming the Home Depot and Lowe's of that space. If you're anybody else, it's very difficult to compete. So, that's another one of these nice growth stories that we see in retail. The other 2 stocks year to date that have done very well is S&P Global. Most people know S&P through their ratings business, but S&P Global does a lot more than ratings. If you think of all the ETFs and indices and also the commodities business, that really it's a subscription business. So they sell data, if you think about it, to Wall Street, to commodities traders, etc. And this is also a very recurring type of revenue business model. So that fits that theme of recurring revenues. The 5th best stock, actually, and this is it's a comeback story, is Apple. I mean, Apple is behaving very well today based on the tariff news. Obviously, Apple is very much disrupted in terms of its supply chain. If something goes wrong in China, the iPhone, as you probably know, is pretty much made in China. And if you think about where all the parts come from in an iPhone, it's sourced from about 20 countries, from Europe, from the United States, all over the place. And a lot of the times the parts cross borders more than just once. So if you think about tariffs going up all over the world, every time a supply chain gets disrupted like that, it obviously hurts margins and so forth. So that's why Apple has had its troubles going into this year, but it's recovered nicely. So our outlook for the second half of the year, look, I mean, we're up 20% at this rate. That's a lot. So we feel like there's a nice buffer built in here for the rest of the year. I wouldn't be surprised if we give back some performance. If you think about the macro data, it's certainly the leading indicators and so forth are rolling over. So that's typical for the later stage or the later part of the business cycle. But you have to remember, at the later stages of the business cycle, you tend to get some pretty outsized returns in the stock market. So our market monitor, our CGL market monitor, which our strategist Terry Gardner puts together and looks at every month, that's still indicating that stocks should be the place to be certainly versus bonds. We have a low GDP growth environment. That's typically good for growth stocks. As long as interest rates are low and inflation are low, that's kind of the perfect environment for growth stocks. So we're not surprised that you're seeing all the action in that space. Positioning, again, as I mentioned, a lot of our emphasis when we're analyzing individual stocks is to find companies that have a bulletproof business model, and that's what we call bulldog stocks. These bulldogs that then have recurring revenues, that's even more interesting for us. So on the tech side, just to give you a couple of examples, I mean, you saw the earnings that came out of Adobe. I mean, Adobe has 80 to 90% recurring revenues at this point. That's the perfect kind of company that we like. High margins, high recurring revenues. Autodesk is another company on the growth side that we own in that space. Broadridge, S&P Global, I mentioned those two. The other one is SS&C. SS&C is basically a technology backbone company that provides all of the platform support behind big wealth managers, like Schwab and Fidelity. Basically, they're run on these types of systems. On the retail side, think about Costco, also recurring revenues. I mean, look, I'm somebody that is probably in a Costco every weekend. If they increase my membership fee by 10% or 20%, I wouldn't think twice. This is an amazing business model. They obviously sell their goods and services at almost no markup. So for the customer, it's a bargain place to shop as long as you are willing to pay that membership fee. The same goes with Amazon. Amazon Prime, that's the recurring revenue part of the business, which obviously makes it very attractive for its customers. And two other stocks that we increasingly like are American Tower and Crown Castle. These are cell phone tower companies. If you think about the 5G rollout that's coming, for the 5G technology to work, we're going to need a lot more antennas and also the number of antennas. I mean, the number of antennas will go up, and the type of antennas that go on these towers will also be different. So the tower companies have contracted revenues. Again, that's recurring revenue that we like to see. So that's kind of a little bit on the positioning on the equity side. On the fixed income side, look, rates are incredibly low. We're not finding much to buy. We don't want to go certainly buying longer dated maturities here. So we're holding a lot of cash on the balance side, waiting in anticipation of higher rates. Obviously, with U.S. rates coming down, the U.S. dollar has also come down. So we're warming up a little bit to the European asset class here. I mean, European stocks have been a disaster in the last 2 or 3 years. But look, if you think about the companies that operate there, they're basically global companies. So think of a company like Adidas, which is obviously sports apparel and shoes. Only 4%, it's a German company, but only about 4 or 5% of their revenues is actually in Germany. So it's a global company, but they're painted with the same brush of all the European stocks that are being weighed down basically by two sectors, which is the banking sector and the industrial sector, and that's because of negative interest rates and all these things that are swirling around in the European Union right now with Brexit and all the various uncertainties about elections all over from Germany to all sorts of countries. So, but the European asset class is attractive now that the euro has turned. So we're finally seeing some appreciation of the euro versus the dollar. So we may be looking for some more opportunities there. We have a couple of international stocks in the portfolio, in our regular portfolio already, but there may be some more there. So one last comment is on gold. Again, my colleague Terry Gartner wrote a nice piece today in his weekly on gold. We're seeing gold break out for the first time in a while. So that could be an interesting placeholder as well. If we're worried about the markets, that's an asset class that we may see in some of our more risk-averse portfolios. So that said, that's it for me, and I wish you a happy 4th, and we'll see you in a week.